Hello, this is Martin Möller from UBP's Swiss and Global Equity Portfolio Management team. I'd like to give you an update about what we are seeing on the equity side and how the next couple of months may look like in these extraordinary times. Let's start with what is performing now, what will likely perform in our view in the next couple of months. Since the lows in March, we have around 3/4 of that drop in markets recovered. We are seeing it losing some momentum from here. Regionally, the US and Switzerland have been outperforming year to date and also during the crisis days. Those are markets that have been also doing well over the last 10 or 20 years, very much due to large amount of companies that are creating value, that have high cash flow return investment and interesting business outlooks for the longer term. Style-wise, growth and momentum as well as quality were dominating over the cyclical and value trade. The reopening news has been driving market levels higher, but the riskier part of the market were only performing from time to time. In terms of sectors, especially tech and healthcare have been doing well, while banks, automotive, airlines, hotels, and also real estate have been laggards. This is reflecting again the preference of growth and quality over cyclical companies and value. We would expect the current situation to continue. That means the economy will slowly get better from the significant drop we have seen probably at the low point in March and April. However, it will be a slow process and it's unlikely to overshoot on the upside. More risky is actually a second or third wave of virus impact and economic shutdowns in certain regions, which might actually lead more to a setback again, benefiting the companies that are having some growth and are on the quality spectrum and creating an environment that is quite risky for investments into cyclical and value companies. With that, we see the market behavior as quite rational. It's reflecting trends that have been around for quite a while, and the crisis is arguably accelerating some of the technological advancement that we have seen over the last couple of years. We would expect continuation. In terms of valuation, obviously 2020 earnings will not look good, and the market is focusing rightly on 2021. For some companies, one has to look at even 2022 to expect some earnings levels that are closer to normality. With that, we find the valuation of 17 times earnings of 2021 as fairly reasonable. However, we're still seeing some downgrades. Again, the cyclical and value element of the market is more at risk than the growth and quality part. What are we hearing from companies? The typical assessment of the situation means talking about recovery of business in China. This is a first in, first out effect of the crisis, while Europe and the US is described as challenging, but sequentially better. So the last couple of weeks have been better than the low point in business activity during March and April. The reopening of economies, regions, activities has been a fairly steady process since April and supported markets here. We would expect macroeconomic data like the purchasing manager indices or even unemployment data, so new job losses coming in at lower numbers than the dramatic weakness that we have seen in March, April, to confirm this in the next couple of months, which is overall supportive for the markets. Per sector, it's actually reflecting what I said earlier with technology and healthcare companies pointing out either immediate or medium-term rising opportunities also from the crisis, while other sectors are struggling. Banks are complaining about non-performing loan situation, automotive about the end demand, airlines and hotels about the demand for business travel in particular. Which brings me to the question of what will different sectors look like after the normalization from this crisis. We think one of the areas that will be most impacted is going to be business travel. So far, many airlines are making profits on the business class, on the transatlantic, on the European-Asian routes. However, going forward, this business might be much smaller than before. As other parts like the economy class of a plane, as well as the European short haul, are typically unprofitable, we see a very difficult future for airlines given the business travel impact. Second would be, of course, hotels that are impacted with business travel, less conferences, less business travel here, leading to less demand, even in a normalized situation afterwards. The whole work from home trend would be a second trend that is impacting businesses across the board. We have seen some companies seeing benefits from having part of their workforce working from home, higher productivity in some cases, faster time to markets, less time for bureaucracy and committees has been seen as a positive, aside from medium-term benefits from potentially using less workspace, having less rental expenses in the business, and more working time, working hours from the employees. The health and technology sector would be here enabler for remote work. The health sector, especially on the health technology, could benefit from additional expenditure here and a need for also remote access to health services, like having a consultation with the doctor not in the clinic, but rather via a Skype or Zoom call. Why do we prefer to invest into value creation over investing in so-called value stocks? There are two reasons for us. The one is there are lower risks investing into companies that are consistently creating value. They have proven during crisis times that the business models are solid. The cash flow generation leads often to a situation where these companies have less debt and can defend their cash flows also during more difficult periods. In so-called value stocks, which are often represented by cyclical sectors, the cash flow level is generally weak and cyclical. During good times, high cash flows are used for large amounts of capex, which then leads to overcapacity in the following downturns. That is not helpful, given that in the downturn, cash flows tend to turn zero to negative, and higher levels of debt are even threatening the survival of a company in that value category. In terms of economic development, for the companies that are strong in terms of value creation, we typically just need some support in terms of cushioning the blow of a recession, while for the value stocks, we would really need an overshoot on economic growth in order to see some sustained outperformance. The second reason is a structural observation that we've made, where we find that value stocks have not only currently low value creation as they have cyclically depressed earnings, but the value creation over the cycle tends to be overestimated by market participants, putting some pressure on these stocks on a consistent basis. Thanks for listening. For further information, please contact us or visit our webpage at ubp.com.